Assalamu alaikum, welcome back. So in this video we are going to discuss the causes of differences between the cash book and the bank statement. As we have already seen that we have to reconcile the balance so that we can take the corrected bank balance in the statement of financial position. And for that we prepare two things. The first one is the updated cash book and the second is bank reconciliation statement. Right now in this video we are going to cover the items, the transactions, the entries that you will see in the bank statement but not in the cash book. These the entries that we are now going to study are those that will be found in the bank statement when we are comparing the two, and we will have to adjust them in the cash book by making an updated cash book. Right, so let's begin. The first one is the bank charges, the presence of bank charges and bank interest. Now these will be found in the bank statement. What are they? Bank charges or bank interest, they are monthly fees deducted by the bank, and the business is not notified every time when the bank is deducting this amount because it is recurring in nature. It is monthly. For instance, when we use the services of the bank, for instance of ATM machine, or the cost of running the account, or the cost of finding out the bank balance at regular intervals. Similarly, if you have taken a loan, so the loan interest or the interest on overdraft, that is deducted by the bank directly. So when do we come to know about it? We are not sent an invoice every time for such expenses. Rather, we come to know when we are comparing it with our cash book with the bank statement. That is why it appears in the bank statement but not in the cash book. But since now we know that this is an expense, this was deducted from my bank account, so I have to adjust it in my updated cash book. And the double entry that I will make for this transaction would be, since it is an expense, it will be credited in my updated cash book, and the bank charges or the bank loan interest expense would be debited in its own account. So this is the correcting entry. This is how we will adjust the bank charges or bank interest in the updated cash book. Now this is the first thing. The second thing is, how do we come to know about it? That how do we locate such entry in the bank statement? We have already discussed that whatever is debited in the bank statement is shown on the credit side of the cash book and vice versa. Therefore, if you remember the treatment, if you remember the nature of the account, bank charges is an expense account, right? It is a cash outflow. So cash book would be credited by adjusting this entry, and therefore this entry will appear on the debit side of your bank statement. So when you are comparing your bank statement with your unadjusted cash book, you will see that on the debit column of the bank statement, bank charges or loan interest might appear. So then that would be on the debit side of the bank statement, and it will be adjusted by crediting your cash book, the updated cash book. So this is how we will adjust the bank charges and bank interest. Now second is direct debit. Direct debit, also an expense, but what is this? This is an instruction given by the business to the bank, right? We allow the bank to pay some of our bills, to pay some of our expenses without notifying us every time, right? So the bank is allowed to make payments on our behalf. So who is allowing whom? We, the business, the trade payable, we have to make certain payments to some third party, so we are allowing the bank to make those on our behalf. Now what you need to remember is the timing and the amount of these payments are not fixed. They are made irregularly, they vary in amounts as well, right? Sometimes, however, they are made monthly usually, but the amount is not fixed. For instance, these could be the utility bills, your electricity bills, your water expense, your credit card bills, right? They vary in amount. The charity donations, right? Variable charity donations. So these payments are made irregularly, and the amount is also not fixed. And what is that? That is direct debit. Again, an expense, cash outflow. So how will we adjust this in the updated cash book? Again, this is a cash outflow, so that will be credited in the updated cash book, and whatever that expense is, that will be debited in its own account. And how will we locate this expense in the bank statement? How do we find out that this is a direct debit? That will be shown on the debit side of my bank statement. That is why it will be adjusted in the updated cash book on the credit side. So this is what direct debit is. Now moving towards third, standing order. Very much similar to direct debit. The only difference is that the timing and the amount of this expense, of these payments, is fixed. In direct debit it wasn't fixed, it was variable in nature, it was irregular as well. But in standing order, these expenses are fixed in timing as well as in amount. For instance, your rental payments, or your annual subscription fees for any club, for instance, or your mortgage expenses, right? So these are fixed, the timing is fixed, the amount is fixed. That is standing order. This is the only difference between direct debit and standing order. And again, how will this be corrected? That expense will be debited in its own account, and my updated cash book will be credited, and again they will be shown on the debit side of my bank statement. That is why it will be adjusted on the credit side of the updated cash book. Moving towards the fourth one, credit transfer. So far we were talking about the cash outflow. Now this is cash inflow. Credit transfers. Credit transfers, they are also called direct credits, deposits simply, lodgements, or interbank gyro transfers, right? In the past papers you will see multiple terms used for such entries. Now what are credit transfers? These are the checks received by the business. Cash inflow, cash coming into the business. So the checks received by the business from third parties. Now we are getting payments, someone is paying us, right? But the payment is such that the payment is received directly in the bank account and we are not notified. So since they are directly received in the bank and we are not told, so we haven't made the entry for that in our cash book. So that is why it will be known to us when the bank statement is received. For instance, dividend received from third parties, interest income, or any other investment return if the business has invested in some other company. So how will these be adjusted in the updated cash book? Can you make a guess? Since this is a cash inflow, it will be adjusted by debiting updated cash book now. Right? Our updated cash book, our adjusted cash book will be debited now. Why? Because it is a cash inflow, and whatever the income is, that will be credited. We know that incomes are credited, expenses are debited. So dividend income, interest income, whatever that income is, that will be credited in its own account, and the updated cash book will be debited. And how will we find this type of entry in the bank statement? Now this will appear on the credit side of my bank statement. That is why it will be adjusted on the debit side of my updated cash book. So this is the only adjustment on the debit side of my updated cash book, and the remaining are all on the credit side. The last one, no, second last is dishonored checks. Dishonored checks. What are dishonored checks? The checks which are not honored, the checks which are not welcomed, the checks which are not accepted. So what is that case? This happens, for instance, when we receive payments from the debtors, when we receive checks from the debtors, how do we make the entry? We debit the bank account and we credit the debtor account, right, to show an increase in bank balance and to show a decrease in debtors balance. That is how we make the entry. But sometimes, since that entry has been made by the business, we have made that entry in our cash book, sometimes that check is returned, that check is not honored. There could be multiple reasons for that. For instance, the first one could be there are insufficient funds in your debtors account, that is why the check couldn't be processed. Or it is a stale check. Stale check means an old check. For instance, the date written on that check was older than 6 months. So that check cannot be, and that check wasn't presented in that time period, so that becomes a stale check, right? Due to that, a check could be dishonored. Similarly, there is overwriting on the check, so that once again creates some doubts over the check, right? This could be a reason that the check is dishonored. Or lastly, the amount written in figures and the amount written in words are not matching. So these are some of the reasons which you have to remember because these are sometimes asked, that what could be the reasons for a check being dishonored. So now, when the check is dishonored, the business is not notified right away. We are not told immediately. Rather, we come to know about it when we see that check being dishonored, that check being reversed in the bank statement. So now we have to adjust this in our updated cash book. And how do we do that? We made the entry to record the check by debiting bank and crediting the debtor. Now we just have to reverse this double entry, so that the debtor's balance come back to its original value, as we haven't received anything from the debtor yet. So the debtor will again be debited and my updated cash book will be credited to record a dishonored check. Now updated cash book is being credited. This means that I will find a dishonored check on the debit side of my bank statement. That is why it will be credited in the updated cash book. Lastly, there could be some errors which the business might discover when it compares the cash book with the bank statement, and those errors will have to be corrected in the cash book. Now this will depend upon the nature of the error. What type of error was that? Whether the double entry was made 2 times on the debit side or on the credit side, or with the wrong value. So once verified with the bank statement, it will be corrected accordingly. So these are the entries, the transactions which will be revealed when comparing the cash book with the bank statement, and all of these transactions will be recorded in the updated cash book. Now what we have to see is the format, everything in a T account. What do we do with these items? When we locate them, we have to adjust them in the updated cash book, right? So we start the updated cash book with the balance already extracted from the unadjusted cash book. Now this is a very important step. Students usually forget this, that you have to start your updated cash book with the unadjusted balance carried down. Why? Because some items will be reconciling with the bank statement, right? Not everything has to be corrected. So the balance carried down that you will see in the unadjusted cash book will include all the entries that are there in the bank statement as well. So you have to incorporate that in the updated cash book balance, so that it then includes all the entries, right? All those that were matching before and now those that weren't. So we are now adjusting them. So balance brought down will always be there. You have to start with the balance CD coming from the unadjusted cash book. Now this balance brought down can appear on the credit side as well. If the bank is overdrawn, your bank account is overdrawn, so that brought down can appear on the credit side as well if the CD is on the debit side. So you have to remember this, that you have to start with the opening balance coming from the unadjusted cash book. Now what will appear on the debit side? Only credit transfers, right? Checks received from third parties, for instance interest income or dividend income, and everything else will appear, usually it will appear on the credit side, that is standing order. Payments to third parties, direct debit. What was standing order? The timing and the amount is fixed. In direct debit, the timing and the amount is not fixed. Dishonored checks, and lastly bank charges or bank interests, right? All these will appear on the credit side. And lastly, when you extract your balance carried down, now this balance will go in your statement of financial position, the adjusted final balance. Now if the balance CD is on the credit side, this means that your bank account is an asset, right? It will appear in the current assets section. Or if the balance carried down is on the debit side, so it would be a current liability, and that is bank overdraft. So it could be either case. If you remember the double entries, if you remember the nature of bank statement, that on which side which transaction will appear and how that will be adjusted in the updated cash book, it will be very easy for you to make the updated cash book. Or you just remember the format, that on which side, what appears on the debit side and what appears on the credit side, right? So So that's how we update our cash book, by including all the transactions that were there in the bank statement but not in the cash book. Right? In the next video, we will cover the transactions, the items that are there in the cash book but not in the bank statement. So see you there.